Welcome back, ladies and gentlemen. We have some breaking inputs coming in on GDP numbers for the Indian economy for Q2 of this year. In fact, the expectations was that the Indian economy would have grown by 6.5%, but that number, the real GDP number, has been estimated to grow by 5.4% in Q2 of FY 24-25. In fact, the real GVA has grown by 5.6% in Q2 of FY 24-25. So sluggish growth has been observed in manufacturing is also the data that we're getting, 2.2%. Mining and quarrying at -1%. These are some of the sectors whose data has come up. In fact, agriculture and allied sector has bounced back by registering a growth rate of 3.5% in Q2 of FY 24-25. So that's the number that you're getting of real GVA growth, GDP growth. It was estimated to have grown by 6.5%, but the actual number has come down to 5.4%. In fact, let's take these numbers across to our panel that's joining us right now. And I'm now joined by Suvadeep Rakshit, the Chief Economist at Kotak Institutional Equities. We also have Indranil Pan, Chief Economist at Yes Bank, Devang Shah, the Head of Fixed Income Axis Mutual Fund. Thank you very much, gentlemen, for joining us this evening on ET Now. First things first, let me come to you, Mr. Pan, first. This data is definitely below expectations, but how much can the low base be attributed to these numbers, given that there's been a slowdown in consumption and there's been rising food prices? How do you view these numbers?
Well, I think obviously the numbers are much lower than the estimate that you talked about. Our numbers were GV at 6% and GDP at 6.2%, so that underperformance is also there. So from the expenditure side, we can clearly see a slowdown in terms of the private final consumption expenditure. The government final consumption expenditure, which is its revenue expenditures, has actually sort of performed better in terms of the growth. The gross fixed capital formation, that has also sort of significantly moved lower in terms of growth. Now, the worry possibly comes from the capital formation. We were expecting that the government's expenditure, the capital expenditures, will rise significantly post the election phase. That to a certain extent started to happen, but again, again it did sort of move lower. The steam that was being shown by the private capex, that also possibly is likely to have been weaker. On the production side, I think for me, actually, the worry is the mining sector, which is the manufacturing sector, which is growing at just about 2.2%. We all know that the Q2 profitability of the companies had been lower, but I think the economists were expecting relatively a better number over there. So that is one which has dragged down the overall GVA. And even the construction sector seems to have dragged down the GVA, which gels in well with fixed capital formation being on the weaker side.
Right, Mr. Pan. Right, Mr. Pan, and let me now come to you, Mr. Devang Shah. So what do these numbers that have come in much below expectations and estimates, what does this really mean for full year estimates? We also know that RBI had a projection of 7% overall as far as that number is concerned, 7.2%, which was later brought down to 7%. Same with IMF has been projecting that the economy is going to grow in this fiscal by 7%, and same for IMF at 7%. But what do these numbers that have come in much below expectations, what do these really mean for full year estimates?
So, yeah, actually, it's come as a shock. Somewhere down the line, I think the lowest expectation on the streets were for the GDP were around 6.2, 6.3. So, obviously, it's significantly lower than market expectation. Very, very positive for bond markets. How I look across it from our overall perspective, it leads to at least the revision for the GDP for the full year from RBI. They were probably looking at around 675 to go down now at around 660 to 670 band. So I think there will be a 30 to 25 to 30 odd basis downward revision in their full year projections for growth. And actually it paves way for probable action from RBI, at least in the December policy. There were a lot of concerns after the CPI print. I think this lower GDP number does open up space for RBI to take some action in December policy.
Okay, let me also take in your comments, Mr. Subhadeep Rakshit. What does this really mean for RBI's, monetary policy? Of course, the October print for inflation was pretty high, the highest in past, I think, 9 to about 11 months. But what does this really mean for rate cuts going forward? Is that going to get pushed further? And what kind of rate cuts are you going to be expecting so far as that is concerned? And also, if you could weigh in on, has inflation perhaps peaked out, or is there more concern in the near future in the next few quarters?
So, as Devang pointed out, that this does open up the room for a rate cut in December. But I think it's important to note that the RBI would have a fair sense. I mean, going into the GDP print would have a fair sense of what the numbers have been. It's important to also note that the number has been on the lower side because of the earnings disappointment. And to a great extent, if you kind of break up the earnings disappointment, it would be more of the contraction on the petroleum as well as the chemical side, which are large sectors in themselves within the manufacturing. And that is what is leading to the growth print coming in lower. However, if you were to look at the activity indicators, it still does not indicate a broad-based weakness in terms of the economic activity. For example, if you look at the PMI manufacturing, PMI services, or if you look at some of the other indicators in terms of two-wheelers, etc. So in terms of the RBI's narrative, in terms of supporting a pause, it would be difficult to come off from that position just on the basis of a print on the GDP, especially if you want to kind of look at the inflation prints that have been on the higher side. It's still, if you look at the food prices in November, they have been coming off, but it's still not close to the or significantly below the 6% mark. It will be somewhere around 5.5%. How much of a confidence the RBI has and the kind of pivot that it would have to make in terms of the narrative, that remains to be seen. So for me, I don't think that December is the time that they go in for the rate cut. They possibly sound out the fact that the economy is slowing down. February would possibly be a better policy to look at.
Okay. So February, Mr. Rakshit, February is perhaps the month that you're factoring in a rate cut from RBI to happen. Let me take closing comments from Mr. Pan. And since we're completely running out of time, I'm asking you the last question. In the next few quarters, how do you think the economy is going to pan out in 2025? What are the biggest downside risks that you see? And will these risks be more internal or external in your opinion?
I think it's very difficult to sort of divide internal versus external risk. I think the critical risk from the domestic perspective is that if I really look at the relatively higher food prices, that is obviously affecting the consumption perspectives domestically. So the real wage growth, both on the rural side and the urban side, has been lower. So that's one worry. Yes, people had been talking about the agriculture and how it can boost a rural consumption. Yes, it can get an upside in the immediate post-harvest period, but sustainability may actually become a question. In terms of the rate cut, I think, the external sector, I think the risks are significant. And the bigger challenge for me is the funding of the economic growth, in the sense that if interest rates in the US remain on the higher side, we may be challenged in terms of both FDI flows and the FPI flows. If growth is on the lower side, FPI flows will sort of get affected, which we have been seeing. And domestically, if RBI continues to be on the selling mode on the FX, then that's a liquidity problem. So these are some of the challenges that we see.
Okay, so the downside risks to the Indian economy really pertain. But thank you very much on that note, gentlemen, for joining us and sharing your thoughts on where the Indian economy stands as of now, ladies and gentlemen. The Q2 GDP, the number that was expected for the economy was 6.5%, but the real GDP number that has come out, the Indian economy is estimated to have grown by 5.4% in quarter second of FY24 to 25. And remember, that's the lowest in 7 quarters. There's been a lot of factors because of which that number has come down lower than expectations. Of course, slumping private consumption, also government capex hasn't been as robust as was expected. On that note, it's time for us to wrap up this edition of News Now, but news continues on the other side of this short break. Goodbye and thanks very much for staying tuned.
If you like this video, then like, share and subscribe to ET Now.